Hey everyone, I'm Jen Rogers. Thanks so much for being here. We are joined right now by Edward Jones's senior investment strategist, Mona Mahajan. Mona, great to see you. We're going to be talking about ways investors can be strategic with balancing cash-like instruments in this high-rate environment. Before we dive in, I want to remind everyone out there, it's a great conversation when we all get into it. So put some questions in the chat for Mona, and I will try to get to as many of those as possible and also take our poll question. And with that, let's get started. Mona, I want to start big macro picture on your views on the Fed heading into year end. And for everyone out there, that's also our poll question. So go and take it. Tell us what you think is going to happen with the Fed. So Mona, are we done raising rates? Another rate hike in front of us. What's going to happen?
Yeah, thanks so much, Jen. It is amazing to be here. I'm glad we both got on live, but I will say what great timing for a discussion like this. Now, to your question on the Fed, we just got off a Fed meeting in November. And in fact, our view of that was that Fed Chair Jerome Powell did seem more balanced in his commentary. Now, keep in mind, earlier on in the year, he talked about how the risk was that the Fed wouldn't raise rates enough. This meeting, he talked about actually there's more balance in those risks. There's an equal balance of raising rates too far, too fast, and not raising rates enough. And so we do think that perhaps that was an early signal that the Fed is considering pausing its rate hiking cycle. We see 5.25% and 5.5%, the current Fed funds rate, as actually pretty restrictive versus an inflation rate of sub 4% already. So the Fed funds rate higher than the rate of inflation. The Fed is also going to watch to see if this high interest rate environment has any lag impacts on the economy. They're watching the consumer, they're watching economic growth, they're certainly watching things like the banking system. So we do think for the near term, the Fed is on hold and probably on hold through early 2024.
So when we're already starting to get some questions in the chat, Scott, I see yours. I'm going to go with a couple more big questions before we dive into some of the specifics that I think people are interested in. And really, I think we would be remiss not to mention the geopolitical crises that are going on around the world. What do you see as the near-term and long-term implications for investors out of those right now? I just want to, just to cover that and touch on it.
Yeah, it's a great point and great call out. And I'm glad you mentioned the investment focus because, of course, first and foremost, this is a human tragedy, a human crisis, really. But as we help our clients and investors navigate this volatility, a couple of things we watch. Of course, immediately following the crisis, we did get a bit of this flight to safety response. We saw gold prices rise. We saw the dollar rise. We saw treasury bond yields fall, actually, which was ironically supportive of equity markets. But the second big thing we watch, because the flight to safety was a temporary phenomenon, what we're really watching on a more ongoing basis is what happens with oil and energy prices. And keep in mind, Israel and Gaza themselves, not major oil producing nations. But if there is any potential or scope for escalation in this crisis, you could get some supply shocks in the oil and energy space. Thus far, what we've seen is that, in fact, the outlook for demand has outweighed this potential geopolitical crisis or supply uncertainty. And so the outlook for demand has softened, probably as not only the US, but global economies are heading towards a period of economic cooling. And so we've actually seen oil prices come off the highs they saw immediately following the geopolitical crisis. So that's a good sign for consumers and certainly a good sign for inflation as well.
So, let's turn back to investments. As you mentioned, Fed keeping rates elevated here, 5.25%, 5.5%. Some investors hear that and they're like, "Oh, great! Should I just park all my cash in there?" Talk to us, because that seems to be what I'm seeing in the chat right now. Even just this first question that we had gotten from Scott, like how do you plan for bonds and treasuries or corporates, talking about fixed income in particular right now in this environment for 2024 with, if you've got your cash on hand?
Yeah, it's a great question and probably one we get more often and maybe even most often these days because yes, your CD or your money market fund is yielding 5.25%. And yes, that is more attractive than really any time we've seen in recent history. So what we'd say is, yes, cash should be a part of any portfolio. In fact, it's a great source for emergency funding or project funding. And complementing that cash is really where we're focused on right now. So you may have built an outsized portion of your portfolio around these cash like instruments, given the nice yields they're offering. But what we'd say is, as we're looking into end of 23 and into 24, there's a few risks to holding on to too much cash here. One, there is an opportunity cost. We've already seen equity markets move up over 10% in the S&P 500, so above that 5% return you're getting in CDs. Number two, there is a potential for reinvestment risk. Keep in mind, if the Fed pauses and pivots lower next year, the yields you're getting on some of these instruments may go down over time as well. And then thirdly, and maybe most importantly, is cash tends to be, over any really 30-year period, a lagging asset class. So we are really seeing some interesting opportunities forming in both equities and fixed income. We think fixed income in particular, the investment grade space, has some really compelling opportunities in the months ahead, especially before the Fed starts moving interest rates potentially lower. So we can get into that as well.
Yeah, and that brings us to our poll, actually getting some results here on what people think is actually going to happen with the Fed. We've got about 45% saying yes, they are on hold for an extended time, and another 45% saying no, they have one more hike left, and then
Wow.
just 10% saying no, they have more than that that's going to be left there.
Okay.
So we're kind of divided
Yeah.
in which way to go. I want to put a button on a little bit of the duration in the treasuries, because we had a question here from, let me look, David McDaniel. What's the opinion on purchasing individual 20 to 30-year treasuries with a long-term holding horizon in today's environment? I think you touched on that, but just to really be specific about something that long on the duration.
Yeah, it's a great call out. Look, we do think the opportunity is now to extend your duration. We would find the sweet spot in the 5 to 10 year space. We think the valuations are most compelling there. Now, we did have a move in the 10-year treasury yields from like 5% or so down to 4.5% currently. So that was a large 50 basis point move already. We're hopeful that investors actually have the opportunity to re-enter that trade at somewhere between 4.5% and 5% again. But what we'd say more broadly is, we do think over time, what will happen is that those yields, both in the 10-year space and in the 20 to 30, as they call out, will start to move lower alongside the Fed funds rate. And keep in mind, it's not only the Fed that is potentially lowering rates in 2024. You have global central banks, including the Bank of Canada, the ECB, European Central Bank, Bank of England, all considering pausing rate hikes, certainly, but potentially moving even ahead of the Fed in rate cuts, because those economies have actually fallen into a more precipitous downturn. They haven't hit recessionary environments yet, but we are seeing those economies slow ahead of the US economy. So, an interesting environment. Usually, one of the best predictors of bond returns is also where the bond yield begins. So, really, what we're seeing is, if we're heading towards some sort of peak level in bond yields, we're probably at a really attractive and favorable entry point in bonds broadly. So investment grade bonds, 10 years to 20-year space, probably a good sweet spot. I'd throw in the 5-year as well in there, but really those are safer bonds. You're not only locking in those yields for a longer period of time, but you also have this potential for price appreciation when the Fed pivots lower.
Got a question here for a retiree from Almaldo. As a retiree, what would be the best approach to invest long term while also generating consistent income? And I want to tie that into something that many people are talking about, which is the 60-40 rule, right? So for so long, people have been talking about that as a gold standard. But what are you hearing about that now, and how does that really tie in to how somebody's thinking about long-term investing and retiring?
Yes. No, thank you for calling that out, because we heard for a lot of last year, is 60-40 dead? Death to 60-40. And in fact, what's happening is, we think quite the opposite. Bonds, we think, are going to become a more meaningful part of portfolios going forward. So, we think the best retirement strategy, and of course, 60-40, whether it's that ratio or 70-30 or 80-20, depending on your risk profile, where you are in your retirement journey, what projects and, costs you have lying ahead. It will vary on your individual needs and profile. But generally speaking, as we think about bonds, prior to, really over the last 10 years or so after the great financial crisis, we did see the Fed funds rate close to zero bound. Treasury yields were between 1% and 3%. And people and investors are really pushed out the risk spectrum. They invested primarily in equities, but we saw things like Bitcoin and other speculative assets climb. We think the environment in the next 5 to 10 years looks different. We think the Fed will not return to zero bound. We think Treasury yields will remain elevated, probably in this 3 to 5% range. And in that environment, we think in equities, there's a better mix of growth and value. And in bonds, we do see that becoming a more meaningful part of your portfolio. It's an income generator. It has return potential. And so for anyone that's nearing retirement or in retirement, we would even consider a 50-50. Your bond portfolio is getting you the return profile that you're probably looking for if it's in the 5 to 7% range. So you combine 50% in bonds with 50% in equities, and you're getting a pretty meaningful return prospect ahead. And so we like the 60-40, we like any variation of it, but the important takeaway there is that we think bonds become a more meaningful part of portfolios in the years ahead.
All right, it's a possible 50-50 there. I want to go, let's start talking a little bit about the stock market and equities deeper, because we definitely have some questions coming here about market opportunities. And I guess the most interesting opportunities you see, and some of the questions in here, I've got one on the transition to EV, rail, so some interest in mobility, but then also the banking sector. Do you see private equity and alternative sources of lending taking market share from the banking sector? So as you're looking out at this landscape, and these are some of the things people are thinking about, what do you see as the most interesting opportunities?
Yeah, it's a great point. And look, 2023 was the year of the Magnificent Seven. Large cap technology growth really led the way in equity markets. We do think as we move forward, there will be better balance in leadership. So number one, the old adage of diversification, dollar cost averaging, all rebalancing portfolios as they get more skewed towards one sector or one group of names, all come into play, we think. If you think about valuations, the Magnificent Seven trades at about 25 times next year's earnings, but what we call the S&P 493, the rest of that market trades at about 15 times, so much more reasonably valued and much more scope for upside in terms of valuation and even earnings potential in 2024. So we want to make sure we have areas like cyclical parts of the market, value parts of the market, even some international and small cap, which we think can play some catch up as the economy rebounds in the back half of next year. Now, what we'd say also more broadly to some of the themes that you brought up, we do say innovation and AI are still in the early stages of what we call a secular bull market. So it's not to say we want to wholesale give up on our AI Magnificent Seven trade. We think we may get better valuation opportunities ahead. But when we think about what will drive the US economy and really the global economy, it is productivity. So, growth tends to be productivity growth plus labor force growth. Labor force growth, we know in the US is somewhat stagnant given the demographics, and a lot of developed markets are the same. But productivity is where we see a lot of upside potential, and particularly relative upside potential in the US versus the rest of the globe. A lot of this new innovation, AI technology, is housed here in the US. A lot of those Magnificent Seven names based here in the US. Keep in mind, the rest of the globe will benefit from the actual innovation and products that come out of these names, but the stock indexes themselves will largely be US dominated. And so we think that relative trade has some legs. So think about your domestic portfolios more heavily. Just we would say make sure on the equity side that you're a little bit more balanced, because we could get some catch up nicely in the year ahead from the rest of the 493.
So we've talked about a number of the different baskets here in terms of diversifying. And at the beginning, when we were talking about cash equivalents, you did mention that cash usually over the long haul has not been great. But look, you've raised a number of the risks that we have out there. We have, Robert pointing out here that the government shutdown could be coming, just another point on the landscape that we're not sure about what's going to be happening and what's shifting. So we have a question from Jamie Henry saying, do you have a percentage of cash that is recommended in a portfolio? So even given everything that you've laid out, is there still a role for any cash at all?
We'd say on average, a portfolio has about a 5% cash position. And in some cases, you may need more than 5% because you have a kid going to college or you have a house you want to purchase and you want to make sure that you have liquidity more than anything else. And that's where you really, work with your financial advisor and make sure you're covered on that front. But to your point, there are risks around politics here in the US and geopolitics globally. I'll just touch on the politics because I know the government shutdown is one that may be looming given November 17th is the next kind of hard deadline in terms of refunding and thinking about making sure that we meet our obligations. Now, what I'd say more broadly there is there have been about 20 plus instances of government shutdowns since 1960. On average, if you look at the S&P 500 in the 3 to 6 months following, average positive by 3% and then 7%. So typically what it means is that the government shutdown, while it is probably, causes some uncomfort and really unrest for those employees in particular that are furloughed, those parts of the government, including some of reporting functions that, we may not get a jobs report on time, et cetera. But usually that demand is sidelined, but then reemerges when the government shutdown ends. And so more broadly, we say markets tend to focus on some of the fundamentals we've already talked about: earnings growth, productivity, where we're seeing innovation and relative winners and losers in the broader scope of corporate America. So that tends to be the focus. Hopefully, will be the same way this time around, but certainly a risk that we're monitoring in the weeks ahead.
So here we are. I can't believe it's almost the end of the year, but I guess once Halloween's over, it's done.
Basically,
So what should investors be doing right now to prep, adjust, reallocate as we head into the new year? And I'd love to just touch on a question that we got from Wendy in here, which, as you're thinking about this, is how many ETFs, mutual funds do you need in a portfolio for
yeah.
diversification? So as you're looking at everything at the year end, is there anything to tell her about, is there a magic number out there or a best practice?
Yeah, and no, it's a good question. And look, broadly speaking, as we're looking at our portfolios, we want to make sure we're positioned, especially if you're a long-term investor, for the next 5 to 10 years. If you keep your money largely in equities or in some balance of equities and bonds, the best thing you're doing for yourself is getting yourself exposed to this power of compounding. And Einstein called compounding one of the seventh wonders of the world because really having an asset grow at 7% and keeping it reinvested is your best chance, 7% on average, I should say, is your best chance of building your wealth over time. So first and foremost, you want to make sure that the majority of your kind of discretionary assets or the money you've set aside for investing is allocated in an equity portfolio. And within that equity portfolio, make sure you have some diversification. You want some exposure to the AI trade, but you want exposure to other parts of the market. Think industrials, materials, even parts of financials that may recover over time. And if you have a bond portfolio and hopefully some percentage, 10, 20, 30% or so, depending on your age, and as you get closer to retirement, maybe it's more, make sure it's in a bond portfolio that has a little bit of duration at this point. You don't want to be completely in that shorter end where it's all CDs and money market. You want to make sure you have exposure to 5, 10, even some 20-year, ladder it out like that. And you can work with an advisor who will do this all for you. But that is, in our view, you're set up really well then to take advantage of some of the opportunities that we think are forming ahead. Now, to your point on ETFs and mutual funds. So ETFs tend to be a very low-cost way to get access to an entire market or entire sector. We are quite favorable on having ETFs make up even a large part of your equity exposure. Now, in the areas that we would employ what we call active management or mutual funds, where there's a manager deciding where to go overweight or underweight, it's not just replicating an index or a sector. Those areas include areas like small caps, EM or international, and even high yield bonds, where there's an advantage in getting more information and an active manager that can have access to market information and really go overweight or underweight versus a benchmark. So we'd say for the majority of your portfolio, ETFs, if you like individual names, that's a way to do it. But really, ETFs gives you that broad-based, low-cost exposure. But for portions of it where you want some active management, there's a way to do that as well. And so hopefully we're starting to see a big picture form here, in that there is a simple way to build a portfolio that really sets you up to not only meet, but hopefully exceed your financial goals in the next 10 years or so.